All right, Jake, welcome to the show. How does it feel to be Jake today?
Great. Yeah, we're gonna
Great.
get it working this time. Yeah, excellent.
So, in the little virtual green room we have, we're fighting the Riverside platform here. Just a note to all the listeners who want to be on podcast, go on podcast. When you're using Riverside, the Chrome Internet Explorer is the way to go. It works well. Hopefully, it works well with the Riverside platform. But using Chrome, we're there. So here we are. Without further ado, Jake, welcome us to your world. Welcome to our world, first of all. Thanks for being here. But tell us a
Appreciate
little
it.
bit about who Jake is, where you started, and where you're at now.
Yeah, absolutely. So I run a commercial real estate services company called Clopton Capital. Started that about 18 years ago. Um, I originally, I kind of got into this. I used to trade interbank hedging product futures, like 3-month LIBOR and stuff like that. That's kind of dating myself because LIBOR doesn't exist anymore. And then around like the credit crisis in 2008, 9, got into like my idea was to create an intermediary that helps people find capital. Obviously, you can see that was pretty important at the time, and really, all of this kind of formed from that, right? So we were originally just financing. Now we're a capital advisory as well as an insurance agency, sales brokerage. We do cost seg. We're 1031 QI, and we do like renewables, like solar stuff like that. It's all the same people, right? It's all commercial real estate focused, and real estate investment focused. So that's who we are today. And my day to day is kind of overseeing the different verticals and also running the finance platform. I think the first thing that usually tips me off to somebody that's like coming into the commercial side of things for the first time is when they ask me for a pre-approval or a pre-qualification letter or something like that, right? I mean
Yeah.
that sort of thing doesn't exist in commercial real estate, and I think a lot of people have trouble kind of getting over that. Whereas like in residential, right? I mean, you go and you get like a pre-qualification letter, and then you can go find a house. In commercial real estate, it's kind of backwards, right? So a lot of residential lending is borrower focused and borrower forward, and they underwrite your income. And I'm kind of speaking first and foremost, like you like your house, right?
Hmm.
Right, like that. Your first source of repayment is your personal income, and a lot of residential investment underwriting is kind of similar to that. When you go to the commercial side, it's the opposite, right? I mean, the first source of repayment is, the property itself, and then they kind of look at the borrower. There are commercial loans for residential investment property. But I think the vast majority of people that are doing like SFR rentals, end up with that residential style underwriting first. So that's how I know like somebody's coming into the commercial space first. And in what the difficulty that makes that or that comes from that is, you know, it they're just not approaching the acquisition side the right way sometimes, because they're not doing enough property diligence before they're coming to me to try to get some like financing, right? I mean,
Hmm.
it should be find the property, analyze the property, and then go try financing that like fits around that. And these types of people are usually coming to me first without even a property or an investment, in hand. And I think that's it. Kind of wastes some time on their end, but it's also to me, it's counterintuitive, right? It's like, let me go just get financing for something that doesn't exist yet. So let's like compare like the residential and the commercial side, right? So residential, you're going to have like one unit, right? Like a single family residence. Um, and you have one tenant. On the commercial, let's say you have a 10 unit building, right? And 10 tenants. And let's say you take both of those and you get them down to 1.25 DSCR. So you have like, a dollar and a quarter worth of income for every dollar of loan payments. I would be more comfortable, having 75% LTV against the commercial building than I would having 65% LTV against the single family residence. Mainly because, like, think about it. If you lose one tenant on either of those, in the single family residence, that means I have no more income. The property
Hmm.
doesn't support itself whatsoever. If I lose one tenant on the 10 unit, I'm still 90% occupied. I still got a ton of income. I can still support myself, no problem. So leverage is an interesting question, and it's really going to be so dependent on the property itself and how much income it throws off, and then what type of risks there are, right? These single-family homes, I'm sure people that are listening kind of have those. There's very binary risk, right? They're either there or they're not, and the property either supports itself or doesn't. Whereas that's why I think you get a lot better risk-adjusted returns for the commercial side because you have much more of a cushion, right? And it's not so binary type risk.
Mm-hmm. Risk-adjusted return.
I think the number one thing that's going to allow you to scale is having equity sources, right? And having equity sources that offer you leverage inside the equity stack. Meaning like in a typical equity deal, right, you have you as a sponsor, which I would call the general partners, the GP. And then, structuring, your investor equity is like limited partners, right? So inside of that, you have like an equity waterfall, whereas you're the GP, so you get an outsized return compared to what your LPs get, right? I think that's what's going to allow you to scale the fastest out of anything, not just having debt, but not being constrained by equity, right? I mean, if you have the equity and you have the ability to continue to put down payments, the debt's always going to be there. But let's just put it this, let's do the math real quick. Let's say you have $1 million and you want to buy properties that are worth I don't know, let's say like $4 million a piece, right? If you have $1 million, you could probably buy one property, right? So, but if you have, let's say you did like a typical GP/LP type split, where the general partner inside the equity stack is usually around 10% of the equity. So now your $1 million could actually go into, if each down payment's like $1 million, your $1 million can actually go into 10 properties, right? And you get leverage inside the equity stack for each one of those above what the limited partners are getting. So that's how I see people really able to scale. And then once you get in here and you get these properties under control and maybe you have some sort of like buyout or something like that, right? Like if you increase the NOI, that is how I see people really scale real estate is not just leveraging debt, but understanding how to leverage the equity stack inside of their equity to get exposure to more properties and get outsized returns compared to just their investors. The biggest blind spot I see is people not shopping it enough and thinking that like, oh, we just went to the insurance market and this is what it is, and just kind of taking that answer. Before we started the agency, even I was to a degree, like I didn't fully understand the insurance, aspect of everything we were doing, or that people do, right? I mean, and we started this like 10 years ago. But I was kind of the same, thought process. So you just get insurance and it kind of is what it is, right? Now that we've been running the agency for so long, and I don't run the day-to-day, there's another guy here that runs the day-to-day of the agency. It is absolutely a marketing process, and it's extremely similar to the debt side of the business, right? And the number one thing I tell people about the debt side of the business is, especially when you're dealing with banks or credit or anything, the credit box of every lender is different, and don't always take the first answer that comes to you. Keep shopping, and like you really need a whole bunch of answers. And it's really the same thing on the insurance side, because I'll see guys that just kind of take a policy and then auto renew it year after year and don't really shop it, and end up with something that's 200% more than something else that was on the market. And not only should you shop it, but like each insurance agent has different outlets and stuff like that, right? And I mean, I've even seen guys like, some insurance agents like push people towards more expensive premiums. So you think about it, they have a reason to do that, right? Their commission's based on the side of the premium. So that's the biggest blind spot I see in insurance is not appropriately shopping it, and then not shopping it every single year, especially now, right? Insurance is just getting crazy, and you're getting renewals that are 50%, 100% increases sometimes. So one of the things that we do, especially on the insurance side, is help people model their returns to know what they're actually going to be before they really get into it. And
on the insurance side or on the lending side?
On the insurance side too.
Oh, interesting.
Because this I see happen, especially right now. I see this happen a lot right now. People will get into deals, they'll get in under contract, and they'll look at the owner's insurance policy, right? And they'll say, oh, it must be 10 grand a year, right? but you have no idea what that guy actually has for insurance. And the vast majority of the time, like that guy will actually end up being way underinsured. And also the lender that you're using may have pretty strict requirements or something like that. And so a lot of times what I see is, people get a property under contract and then they have a finance contingency, right? And they kind of get down the road and then they're hard on, earnest money deposit. And then they're like, within the last 2 weeks of the thing, by the way, I need insurance, right?
Yeah.
Insurance comes back and it's 3 times what they thought it was going to be, right? And then that kind of affects everything. But you're so far down the line, you've got money out of pocket, you've got earnest money that's hard, you've got a lot of, lender costs, legal, all this stuff, and this is kind of a surprise. So I see that happen all the time. So one of the things we do, especially with syndicators, people that are modeling deals up front, is, appropriately like bid those insurance quotes and give them like realistic, premiums, like real like live premiums, and like poke holes in like the current owner's policy and stuff like that. Because I've seen it. People go into deals and it turns out the owner, either had an umbrella policy with 10 other properties and he was just allocating part of the insurance to that, or he had, some deductible that was like $500,000 or something like, what I mean? It doesn't make sense. So, that knowing, I think especially in today's world, it's more important than it was before. Just knowing what that is going to be going in is going to help save your deal, and or, maybe it doesn't make sense and the returns come down and you have to like offer like a lower price. So it can help you prevent from like overpaying.